It is now time to move on to multifamily. I'd like to introduce our panel for multifamily. We have Darlene Carter, Division President with CW Urban, as our moderator. And our panelists will be Patrick Bodner, Vice President of CBRE, David Tilliston, VP of Development at SALT Development, Lee Dial, COO, CFO of Cowboy Partners, and Dennis Sagana, Executive Vice President of Pre-Construction for Jacobson Construction.
Thank you. Can you guys hear me? It's hard to tell. Okay. Before we get started today, I wanted to thank the panelists, Patrick, David, Lee, and Dennis, for their participation in the conversation today. You guys probably already know that these individuals represent a diverse set of roles in the multifamily sector. They're all incredibly talented, and they're working on some of the most innovative projects in Salt Lake City right now. So I think we're up for a great information exchange. So to kick off the multifamily story, they asked that I kind of talk through a couple slides, which I can't see, so I'm going to step out a little bit. Whoops. Can we go back one slide? Okay, maybe not. So the first slide is actually, the first slide is cap rates and pricing per unit in Salt Lake City. A couple of the facts that kind of stood out to me is that Salt Lake is most comparable to the Vegas market in cap rate and price per unit. It was really close to Denver in cap, but there was about an $80,000 swing in the actual price per unit. Portland, Phoenix, LA, and Seattle were posting more aggressive cap rates and moderately to significant higher in price per unit. This slide is about the actual total sales volume. We had a big jump, you can see, from 2016 to 2017. We finally reached that billion-dollar threshold that we were waiting for, and that really became the new standard because it held for 3 years. There was a small dip between 2018 and 2019, and we may give a little bit of color to that today. And the final slide, which I really liked the information on it, because I thought it really told a story about what the potential of where Salt Lake City could actually go. We see here that Salt Lake City has some of the lowest percentage to income, lowest percentage of income to rent in the actual markets. I thought it was also telling that Salt Lake City was higher than Phoenix and Portland in actual income, but very comparable to Denver, and we actually had the lower rates. So that being said, I want to flip it to the panel now. After reviewing these stats, is there a particular number, story that jumps out to you as what could be the drivers of this market? So Patrick, I'll start with you.
Great. Thank you very much, Darlene. The most important stat really is not really on this board at all. It was the email I got from Snowbird this morning that we had 11 inches last night. So very important stat, and speaks to Darren Malot's focus, which is lifestyle, right? I mean, that's the part of the lifestyle. That's why we live here. We love it. But anyways, lots of powder up in the mountains.
Awesome.
Back to real estate.
I was packing my kids' lunch at 6 a.m., so I missed that one.
Back to real estate. You know, what some of the major drivers are here in this market. I just returned late last night from Orlando, Florida. In the last 4 days, attending the National Multi-Housing Council Conference, NMHC, held annually. It swaps coast year to year. But the bottom line is that there is an enormous amount of capital chasing multifamily assets in this marketplace and across the nation. It's tremendous, truly tremendous. 3-4 years ago, you'd go to this conference and people would talk about, hey, we've got 300 million. And then it went, hey, we've got $500,000 for 500 million. Hey, we've got 750 million. Last year, it was $1 billion, and we were like, don't talk to me unless you have $1 billion to spend. in our market, we're an emerging market, right? We have all kinds of incredible fundamentals that are very strong, from job growth, in-migration, 27,000 estimated this last year, 24 the previous year. These are great stats. We've already heard about the young population demographic, and more importantly, I think a very well-balanced economy across technology, the financial sector, and healthcare. These areas are where so much more of the higher paying wages are coming from. And yet, as the slide shows, we have a lot less in total amount of that income going towards rent at a much smaller percentage compared to the other markets. At this conference, in addition to learning all about this, quick story, Blackstone was brought up earlier on the panel. You know, Blackstone is raising $1 billion a month. $1 billion a month. They sold $2 billion last year. That's twice the size of our market over 2019. And they purchased $7 billion. I mean, that's how they're raising $1 billion. They're purchasing $7 billion. That's 7 times our current market. And yet we have some of the most sought-after fundamentals by an institution like Blackstone or other similar large institutional firms and or private equity firms seeking to enter the market.
Patrick, just if I could push you to give a little more color on, I think we say these numbers and we talk about them and we don't realize what the impact is. So as a broker, your actual workload, how many calls do you get in a day and a week from large private equity groups or institutional capital, or when a project goes on the market? What's the difference in actual tours, calls that you're getting on a project now that maybe you didn't even see 1 to 2 years ago?
Great question, and it certainly has been ramping up, just like the scale of total sales volume. We see in our marketplace, and have seen over the course of 2 years, you know, more interest in calls from developers regionally over the last 6 months than I've seen in the last 8 months or 2 years. They want Utah. They want to be a part of what's going on here. Our total CAs for properties that we take to market, we just took a Vita 400-unit property in Murray that was a Core Plus deal built in 2012. And had a great opportunity. There was some upside in the potential rents, some renovation that would drive that as well. We had well over 30 tours and about 140 CAs signed or more. I mean, that's very consistent across a lot of the large assets that we're taking to market. And it's important to see that many of these institutional large private equity firms really like to cluster. They want to know that their competitors are in the marketplace because it offers them that future exit. They realize that there is scalability here. They realize there's liquidity here now that we're seeing more trades. I mean, the key is to keep building. And we'll talk more about absorption and some other things that are going on with regards to the velocity of the lease-up of many new projects, and to speak to the point earlier of how we sit at a large amount of office space in the marketplace, 2,000 square feet, as Kit mentioned, to every 1 unit provided. Well, it's really interesting when you drive home and you consider, well, what does that 2,000 translate in terms of net job creation? Well, estimating 200 to 250 square feet per employee, you're looking at about an 8 jobs created for every 1 unit delivered in the marketplace. Seattle today, it's every 4 to 4.5 jobs. We're double that. So do we need more units? We absolutely do. We absolutely need more units.
Yeah, that's a great stat. David, let me ask you, you're widely known as someone who has had some wildly successful projects and did come from out of state. So, I mean, what was the motivation for that? And why stay after you're here?
Yeah, so, I mean, kind of pointing to Patrick's points, right? I mean, you look at some of these other markets, and to touch on Darren's points earlier today, Salt Lake is very much a tier 2, but really tier 1.5. We're in that category with the Denvers, Austins, Portlands of the world. But when you look at that chart of yields, capital looks at that as well, and the reason they're going to secondary markets is they're chasing yield. And when you compare us to the other secondary markets out there, we still have higher returns than the Denvers and especially the West Coast markets. So I do think it is an attractive component of investing and developing in Salt Lake. The other thing that Salt Lake has, given the lifestyle, given the demographics, is we have rent growth, right? And being able to continually, year after year, have that rent growth, and for institutional capital to be able to underwrite that rent growth in their pro formas makes a big difference. Now, on the flip side, you've got states like California, Oregon that are having state-imposed caps on rent growth. Now, yeah, the limits are high, but at the same time, it's a slippery slope, and I think institutional investors are looking at those legislative changes as a negative and gravitating towards more red states like Utah for their investment.
Great. I think we just painted what seems to be all rainbow and roses, right? The market wind is at our backs. But I think most of us can say that every single day we're working on really complicated problems, and there's significant challenges in multifamily and development right now. I think the number one that we always talk about is costs. And costs are really rising across the board. Land costs specifically, when a new piece of dirt goes out, I think I get emailed like by 17 different people and 25 offers go out on it. And hard cost constructions are at an all-time high. So that really forces our developers to be able to be, forces them to be more creative. So Lee, why don't you tell me a little bit about how you've overcome some of those challenges and still are going vertical on some really amazing projects.
Yeah, thank you. We're certainly no stranger to it, not immune to increased costs, and we've heard from a few contractors today talking about the increase of costs. Just anecdotally, I think about one of our own projects, Liberty Gateway, over there just west of the Gateway Retail Center. We finished that one up in roughly 2013. And our cost per rentable square foot on that was roughly $127 a square foot. And at that time, we actually felt like we'd kind of been taken behind the woodshed on that price. Thought it was pretty high. But I'm fairly confident if we built that same product today, we'd probably be looking at a price of $250 a rentable square foot. So easily double, and yet my rents haven't doubled. So obviously that means that my yields have compressed and my margins have compressed substantially. So while none of us like that, it does force innovation. And so I think about just the different things happening out there in construction right now. And so you have a few things out there that you've probably heard of, such as a prescient system, where it's a prefabricated framing structure that goes up extremely fast. So if you haven't seen that, you ought to look at it. But the challenge with that is GCs and stubs still have to catch up with that technology, because as fast as that framing goes up, if they can't keep up, the other subs and trades, then you're not getting the benefit out of that technology. Same goes for things like modular construction, which we see a lot of modular plants being built around the country, particularly in Idaho and Utah here close to us. Again, it's just a matter of trades and GCs keeping up with some of that technology and figuring out how to utilize those technologies. So it's something that at Cowboy, we're looking at both of those kind of systems. We also look at precast parking structures, which are gaining some popularity, or parking systems that look to maximize the number of stalls you can park in a lower square footage. We also look at creative financing with our financing partners. And so that's been a help for some of our deals to try and help keep that yield a little bit higher. One of our most recent deals, Liberty Sky, which is one of the high rises going up right now. We broke ground on that in September. And so we partnered with Dennis Sagana here and Jacobson Construction just to, I wouldn't say there's any like grand macro savings thing or innovation we did on that, but it was really just looking at every single component of that project, all the way from how we move dirt, how you place the aggregate piles, to how you place windows, to how you form and pour cement, to even partnering with just our great partner, the Boyer Company, and figuring out how to utilize and maximize the space. In that particular project, we're actually putting our parking structure right next to their existing parking structure to be able to take advantage of some of their ramping, so we didn't have to use square footage for that ramping.
Yeah. Dennis, we asked you to be here today to kind of speak for the general contractors in the room, because they're a big component of the process. So how do you think that general contractors right now are participating and linking arms with developers to actually ensure projects get off the ground so they have a great workflow? And what do you think, as the general contractor yourself, are your challenges or risks that today's market's actually posing for your company?
Sure. Well, to tackle the first question with regards to getting projects off the ground and trying to contain costs, we get involved early on the projects. That's the key thing. We talk about value engineering always, and a lot of times we get brought onto projects when the design's already incorporated and there's a budget issue, and then we look at value engineering. Well, for instance, on the Kensington Tower that we're involved with, we were brought on several weeks after the architect. So there was no design, it was conceptual, they had an idea of what they were looking at, and we're partners at the table from that time, looking at different systems, exploring what's right for that project and the costs. Lee mentioned the Liberty Sky project. I'll share an experience there. Dan called me on the State Street project and said, hey, I'd like you to look at this wood frame structure, a multifamily. We went in there, ran some numbers, they didn't work. So we kept an open mind, thinking outside the box. We've got some peer partners nationally. We said, they've done some multifamily high-rise projects. What about putting that on this project? And so we're spending more time with developers early on that one there. Dan and I took a trip to Denver. We went to Kansas City. We explored those buildings, looked at what really makes those, how can you get those projects efficient so that they worked with the developer performers. So we're seeing a lot more engagement early on with the developers on projects to help them be successful.
Yeah.
The second one, with regards to risk, you heard it from everyone here, it's the labor. With the low unemployment rate, our job growth in construction being close to the highest in the nation, there's no surprise that we're all competing for the same craft workers. And these guys out in the field, they need to get the projects done. But they're willing to go to our competitors or another contractor or where someone is paying them per diem per day, even if it's only a 50-cent an hour increase. So the biggest risk is the subcontractors we have out there right now. Some of them are overextending themselves. They're not able to get the manpower that they need on these projects. It's going to impact our schedule. As a contractor, we just ran into a situation where we signed a GMP with a client, had all the contracts issued to our subcontractors, and someone came back and said, look, I just lost my top 2 guys. I'm walking away from this job. So as a contractor, we're holding a deficit of the six-digit number. So there's costs associated with what's going on, and then just the subcontractor's performance out there and being able to get the manpower.
Yeah, I echo what you said. I think most developers, it's very wise to get the contractors involved at the very beginning, and it's helped them. For the projects that are getting off the ground, if they've overcome all these obstacles, we really are setting records every day for land prices and exit caps. So how do you interpret these escalated values today? Does that mean that this is an indicator of the new market, the new standard? And if that is the case, will there be a material shift for the future? So Patrick, maybe speak to a little bit about that.
Yes, I believe it is a new market. And I'll say something, I think we're only on second base. Mm-hmm. When you compare, these large institutional private equity firms that are out there searching for yield and finding the right assets, they're playing chess. They're looking at, the western states markets, and they are moving pieces across, Portland to Seattle, and Seattle to Phoenix, and Salt Lake to Denver, and back over to LA. And as they do that, and they're making their decisions, they look at those fundamentals that are drawing the most yield and the most opportunity, sometimes very project specific and sometimes very market specific. Now, on the whole, as you saw with the numbers, we sit at a greater yield on those cap rates, but those yields extend across your cash on cash, your IRR, your levered IRRs, and what that does for this market is it brings in that attention. And what's it all driven? Well, Kyle mentioned it earlier with regards to industrial. We're not at inverted exit cap rates on multifamily just yet, but it is all being underwritten because of the strength of rent growth. Case in point, overall, our market average sits at about $1.35, and it's kind of bounced right there for some time. It's probably certainly been up over the last 3 years, 10 to 15 cents. Denver, $2.35. It's a whole dollar higher. So in a smaller world, even economic world, where rising tides lift all boats, we're certainly going to see more investment in this market from the Starwoods, the Fairfields, the Blackstones, the Blue Rocks that want to participate here. And we're going to have to make certain that we're delivering the kind of projects that are going to be most desired for that tenant base to pay that higher dollar. The actual tenant profile demographic is not all that much different. It is some different, and certainly wage growth needs to be driven in this market. But the reality is, with that vision of future and forward rent growth, they can pay those numbers today.
Well, I don't want to botch a sports analogy, but I actually liked the second base analogy because that means we actually haven't realized the hit yet. So, David, where do you feel like you're at? Would you agree you're on second base, or are you turning the corner yet?
Yeah, no, I think we're on second base. I think institutional capital is just looking to get into this market. We're really at there's just not enough deals out there for the capital that wants to get in the market. When you look at land pricing, right, it's the same scenario. There's so many markets out there that are more constrained, more urban markets, and people don't just look at these markets on a per square foot. That's what you're paying for the land. They look at what's buildable. They start looking at FAR per price per door, price per FAR. And that's really, I think, where Salt Lake City is headed.
Yeah. Thank you. I don't think that anybody's having a multifamily panel in Utah right now that doesn't bring up the towers, because it really is changing the skyline of Salt Lake City and is really a new standard for what Utah could be. So, Lee, why don't you speak to what just the impact of that particular type of construction, how it has influence on Salt Lake City and the overall state of Utah?
Well, to me, I think the only reasonable logic behind all these towers being announced and being built is due to the legalization of medical marijuana. It's pretty crazy. It's no coincidence that the Kensington Tower is going to be 420 square feet in the air. You can fact check me on that one later. But it definitely is changing the skyline, and I think there's various reasons for that. But as has been brought up many times, Salt Lake is certainly emerging, if not definitely well positioned into a secondary market at this point. And so, as I look at our renter demographics, especially in the CBD, another reference there.
Amazon will get it to you in one day, right?
But our renter profile in the downtown market is largely out of state. And a lot of those are coming in from the West Coast, a lot even from the East Coast, where it's normal to live in a high-rise apartment building. And so when they come to the Salt Lake market to work for the startup technology companies, or specifically downtown for like the Goldman Sachs or Fidelity or whoever it may be, they expect to see that. And so right now that's not in this market, and so it's kind of a niche that can be still filled. And so players are coming in from outside. It's mainly, most of these towers, if you look at them, are from outside developers. So I think Cowboy's probably the only local developer building a high-rise at this moment. And so when you're coming in with institutional capital from outside markets, that's normal for them as well to build a high-rise. And so if you need to obtain top-of-the-market rents to be able to make construction pencil, then what you need to do is be able to attract the people that will pay those top-of-the-market rents. And that's a very small group of people, very at the very top of that sort of pyramid, if you will. And they've seen that David's been able to charge those kind of rents over at Fourth West in the hardware apartments, and so that gives them some courage. They're further bolstered by the fact that a local developer's already come out of the ground with a high rise. And so they look at that and say, yeah, this is a good niche where if we need to get those renters and that product isn't in place, then we can attract that upper echelon of renters to come here. And then as we get transplants that come into the state of Utah and specifically to Salt Lake, and they see these high rises, it feels natural to them, feels like home, and so they keep coming. And I think it's overall good for the entire Salt Lake economy as we become more of just entrenched as that secondary market.
I think one of the points you made, and probably it hits home with me specifically because we are a smaller shop, is Cowboy really is the only local developer who's doing a high rise. And so I think it has also pushed the local developers to try and find niches. I think for our shop, it's really focused us to say, okay, and for any of the developers who are in that same bucket, you have to ask yourself, well, how do I still deliver value to the market? Is that infill projects? Is that townhome projects? It's one of the reasons why we're going long on for-sale condos in Salt Lake City, which haven't been built in the last 10 years, because you have to provide some sort of different value than what's being done. So. It looks like video is up, and so our time is up, and we're going to kick it to the audience for some more questions. So
we definitely are. Thank you, great panel, and for all your insight. Here's some of the questions that we have. Tell us a little bit about the different demands, the balance between affordable, mid-level, and luxury. Is there a balance between those? Where are we at on percentages?
I don't know if I can speak to the exact percentages, but I think right now, just because of where costs are, I think everybody is generally building to the top of the market because construction costs have certainly outpaced rent growth. And so the only way to make a deal pencil is to be able to achieve the highest rent that you possibly can. The problem with that is there's only so much room in that area. As one of my favorite bankers said one time, I'm going to vomit if I hear one more apartment developer tell me they're going to fill their building up with Goldman Sachs employees. But,
or jazz players.
Yeah.
They live in every great building.
But I think where the real demand is that we struggle with is in the affordable component. And so that's not just working with specific like low-income tax credits, but it's even just trying to figure out ways to build affordable product that maybe reaches 80% of AMI, or trying to build 65% of AMI without tax credits. So I think that's where the biggest demand is, in my opinion, but it's just a challenge to try and get that built with where costs are. So it's trying to become innovative and figure out ways to do that.
If I can respond to that too, CBRE did some research on this in conjunction with the Downtown Alliance at a presentation earlier this fall, and what was noted is that, you know, what we all know, I mean, the affordability need will always remain and will always tend to grow. That's part of being in society today. However, it was also identified that the luxury need was absolutely in short supply, and which is why we've seen such great success with some of the luxury product delivered like Fourth West and hardware specifically. But I think to stay on the baseball analogy, I mean, if you build it, Lee, they will come. And that's what's going to happen. I mean, we do have a growing economy, and they want the experiential living like is provided by the gentrification of downtown and all that's now being provided through the retail efforts and what was shared earlier. And that's the amenity that extends beyond what just that luxury product delivers. And you know, community really is the new amenity.
I was going to say that's exactly how I feel. It's what is the definition of luxury? Is it fit and finish on a building? Is it location of a building? Is it walkability? Is it how that project actually encompassed a greater community or sense of stickiness for the residents so that they would never want to leave? And I think those intangible things are the things that developers now are thinking about more than ever before, as opposed to just, well, what should my countertop be and what should my exterior facade be?
It's all about amenities. Another question, with the market needs of having so much more density, how do you work with the different communities and cities to add in these multifamily homes there?
So I can answer that a little bit with our next project. What we're doing is we're moving towards smaller units in order to get that density and get that the heads and beds, essentially, as you will. So we're actually looking at a project that'll be 300 units, 150 which are exclusively studios, and 150 are true co-living units, where residents will have kind of their own private, small space, 280 square feet, but it's a true co-living concept, and it's, again, creating that sense of community. So getting density in alternative ways, I think, is key.
I think to speak to, part of the spirit of the question is how do we get our neighbors on board with it? It's not easy. I think we all know that. And I think the most important thing to remember is that it cannot be the developer's sole responsibility to get the neighboring community on board with density. It's going to take every single person in this room. It's going to take our city officials. It's going to take our council members. It's going to take a better education of actually just the general public on, if we say we believe in affordable housing, how does that actually deliver to a market? It is through higher density. But I think there has been a little bit of an onerous task placed on the developer's back to carry the load to convince municipalities and communities that density is the way. And I think we've got to have a bigger conversation with more people involved to help us propel that message forward.
So with these buildings going higher, the cost is higher to go because you switch from wood construction to concrete and steel and things like that. And with this is a combination of several questions, and with the lack of labor, how do you deal with, or is there a sacrifice on quality? And how do you manage that to fit into your
sacrifice.
A type 1A concrete structure is more robust and stout than a wood frame structure out there. So you need to look at different systems, and as you indicated, you don't sacrifice. They do come at a premium, but I think your rent, you're going to try to charge a little bit more rent to offset that cost. But there's different building systems out there, and like I said, we meet with our peer group partners nationwide and looked at some of these high rises. We make sure that our forming systems are the right systems, that we have the right cycle time, that we cut construction period and time. We look at lean principles. We've looked at in the past, actually, on Liberty Sky, we looked at possibly pre-manufacturing all the bathroom pods off-site. Back then, 2-3 years ago, the labor cost was less and there wasn't much of an issue with it. Now I wish maybe we would have done that. But we're always looking at different products that are out there. We got to reach outside of our market. And our peer groups have been helping us. We on the Kensington, for instance, it's a high structure. It's 30-something stories, and your typical curtain wall system or window wall system may not be out there. There's other options out there that we're talking to developers that they're using in order to keep their costs down.
Excellent. Thank you all for your insight on multifamily. We appreciate your time.
Thank you.
Can we hit the fire?